As we speak, the S&P 500 futures are trading around 6,725, which is up a very slight 0.1%. The Nasdaq 100 futures are also trying to find a footing, up about 0.08% near 22,890. You're asking why the market is down, and looking at these tiny green numbers might be confusing, but they tell the entire story. The market isn't down in the last 5 minutes, it's broken from yesterday. These fractional gains mean nothing against the carnage we saw in the last session. Yesterday, the S&P 500 plummeted 1.66%, and the tech-heavy Nasdaq composite collapsed by 2.29%. So the real question isn't why the market is down today, but why it fell off a cliff yesterday, and why today's bounce is so anemic and unconvincing. The immediate answer is that the entire investing thesis for the fourth quarter just vanished. The market is now flying completely blind, and the Federal Reserve is flying blind with it. The great expectation that has been building for weeks was that the Federal Reserve was on the verge of a full-scale policy pivot. The narrative was simple. Inflation was cooling, the labor market was softening, and the Fed would finally get the green light to start signaling rate cuts, perhaps as early as their December meeting. This hope of cheaper capital is what has been holding up stock valuations, especially in the high-growth technology sector. The recent 43-day government shutdown was seen by many as just a political sideshow, a temporary inconvenience that would pass. Investors were positioning for a year-end rally, believing the path forward was clear. But the reality that just punched the market in the face is that the shutdown wasn't a blip, it was a bomb that just detonated in the Federal Reserve's boardroom. We are now learning, and the market is now processing, that key economic reports for October, specifically the all-important inflation, CPI, and labor market, jobs reports, are likely never going to be released. They are gone. This is a catastrophic failure of data. The Federal Reserve, which has spent 2 years telling the market it is 100% data dependent, suddenly has no data. It has no inflation reading, it has no jobs reading, and it's supposed to make a critical decision on interest rates in just a few weeks. This isn't just a minor setback, it destroys the very foundation of Fed policy. The market has moved from a state of data-driven confidence to one of total blinding uncertainty. And if there is one thing institutions hate more than bad news, it's no news when they need it most. This is why yesterday's sell-off was so brutal and why today's bounce is non-existent. The selling was not a nuanced adjustment. It was a panic-driven repricing. The odds of a December rate cut, which were climbing, have now evaporated. Traders are no longer betting on when the Fed will cut. They are terrified of what the Fed might do wrong. Without data, any move the Fed makes is a guess. If they cut, they risk reigniting inflation they can't even measure. If they hold or sound aggressive, they risk crushing an economy they can't accurately assess. This is the definition of a policy error, and the market is now pricing in that risk. The sell-off was led by the very names that were an AI bubble to some and the future to others. We saw heavyweights like Nvidia and Broadcom get hit hard, falling over 3.5% and 4% respectively. This wasn't just profit-taking, it was a fundamental reevaluation. If the cost of borrowing stays high because the Fed is too scared to move, the high-flying valuations on these AI-related stocks look completely unjustifiable. The entire tech sector, which lives on the promise of future earnings, just saw its discount rate spike. This brings us to the short side of the market, because a macro environment this confusing is a paradise for institutional short sellers. They aren't just targeting individual stocks, they are placing massive bets against the entire market using index ETFs. The volume on SPY, the S&P 500 ETF, and QQQ, the Nasdaq 100 ETF, was enormous yesterday, and much of it was selling pressure. This is likely to attract even more short interest. For context, as of the last reporting period at the end of October, the short interest on SPY was already significant, standing at over 108 million shares. The days to cover was about 1.4, which is not extremely high, but on a day like yesterday, you can be sure new large short positions were initiated. What investors need to watch for now is not just the price, but the underlying mechanics. You can look for data on the put-call ratio. This ratio measures the number of bearish put options being bought versus bullish call options. Yesterday, that ratio almost certainly spiked, showing a rush for protection and downside bets. For those looking for actionable insights, this is where you need to be careful. Recognizing a broad market shorting campaign is very different from identifying a short squeeze in a single stock. You cannot squeeze the entire S&P 500. This is not a retail versus hedge fund battle. This is institutional consensus that risk is too high. You can monitor the CBOE Volatility Index, or the VIX. The VIX measures the market's expectation of 30-day volatility. It's the fear gauge, and it exploded higher yesterday. When the VIX is high, it means the cost of insurance, put options, is expensive, and fear is the dominant emotion. Another data set to watch, though it is delayed, is the fails to deliver, or FTD data. When you see a massive spike in FTDs for an ETF like SPY, it can sometimes indicate stress in the settlement system or concentrated aggressive shorting. We saw some of these spikes back in September, and it will be critical to see what the data for this week looks like when it's released. What's your take on this new uncertainty? Do you think the Fed will actually cut rates in December without the October inflation and jobs data, or is that hope completely gone? The sentiment on forums and social media has seen a complete 180. Just last week, discussions were focused on which AI stock would be the next to break out. Today, the conversation is dominated by fear, confusion, and anger over the data black hole. The buy the dip crowd is being drowned out by those asking if this is the start of a much larger correction. This psychological shift is important because retail investors have been a key source of buying pressure, and if they are now scared, it removes a major support from underneath the market. The AI-heavy narrative is being seriously questioned, with many wondering if the rally was built on hype rather than a sustainable business environment. Looking forward, the market is trapped. The expectation of a smooth, data-led glide path to lower rates is gone. The reality is a fog of war. The most significant risk is that this uncertainty compounds. The market now has to wait for the next set of data, likely incomplete numbers for November, and that data will now carry a disproportionate weight. A single hot number could send the market spiraling downward as the Fed will be tempted to overreact. We are also hearing that there are specific chart levels to watch. Some analysts are pointing to 6,631 for the S&P 500 and 599 for the QQQ as the must-hold support lines. If we break below those, the technical picture gets very ugly very fast. The only opportunity in this market is for the extremely cautious, perhaps in defensive sectors like utilities or healthcare that are less tied to economic cycles. But for the broad market, the game has changed. This is a tough day, and it's clarifying to see what real investors are doing. Comment below with your strategy for today. Are you buying this tiny, unconvincing bounce, or are you selling? Or are you just sitting on your hands and waiting for the dust to settle? To summarize, the market is at a standstill today because it was shattered yesterday. The narrative that everyone trusted, that the Fed would be guided by cooling data to cut rates, has been invalidated. The shutdown's consequence was not political theater, it was the destruction of the very data the Fed and the market need to function. The expectation was clarity. The reality is a black hole of uncertainty. This has given bears and short sellers the upper hand, it has terrified the bulls, and it leaves the market's next direction entirely dependent on how the Federal Reserve chooses to guess at its next policy meeting.